Hey, my name's David. I'm the founder of Green Mountain Advisors. We're an alternative investments group that focuses on venture capital, private equity, emerging markets, special situations, and tail risk hedging. Over the past 8 years, I've averaged about $3 billion in annual transaction volume. So I know how to manage risk and I understand the quantitative methods used in hedge funds and in private businesses to create outsized returns. And I'm creating this video series for founders so that they can improve their business, so that they can grow, they can scale. Between myself and my operating partners, we've had several 8-figure exits, and I'd like this video series to be geared towards the first time founder who's trying to either grow their company to something that's like $100 million or to help them make their first exit. And over the past 2 years, we work with businesses where we've taken something that was doing $500,000, and 3 months later, we were ready to do $2 million for the next year, right? So it doesn't take long to grow your business if you have the right operating and financial procedures in place to scale the company. Because it's not just about sales, it's about how you run the entire business. It's not just doing marketing for a product or service, it's about creating a real sustainable company that you could one day sell or check out of where you're not part of the day to day. So this video will be about how founders should think about their KPIs, because I think that one of the biggest hurdles a lot of founders have is they'll go on ChatGPT or they'll go to some conference, some speaker or the ChatGPT will tell them, okay, you got to focus on this for this function in your business, and then you got to do this. And it completely throws them off track on how they should actually scale their company. So this video will be meant to help you think about your KPIs and how you can reverse engineer what you really want, which is to scale your company. And the most important KPI that you should be measuring is the relationship between your intangibles and your actual results that those intangibles yield. So the amount of time you spend is an intangible, but it does yield real results. It's a very simple example. And as we go further, you're going to see how the combination of all these intangibles creates the outsized return, that competitive X factor that isn't found in any other company. And it's why you are unique. It's why you're making sales. And the reality is those intangibles are more valuable than any tangible in your business. Everything else can be replaced, but the intangibles, the things that are the most hardest to measure, are what really moves the needle in the long term. And we care about the long term for you and your company. And the thing is, as a first time founder or second time founder or just general entrepreneur and you're running your digital business, all you need to do is think outside the box. You really have all the resources you need. You could bootstrap yourself to millions of dollars if you'd like, because you really have all the resources necessary to do so. When you go and you approach investors like us and ask for venture capital, what you're really saying is, I have an idea that either has a first mover's advantage or I have a system and models built out that can obviously be improved on. But I know that if we just applied some more money, some more leverage, we could scale this thing faster and we can compress the feedback loop that happens when you run a business, because everything is a feedback loop. So what are all the functions involved in running a business and how should you think about your KPIs? Well, your KPIs will all fall into these buckets. You're going to have your R&D, you're going to have your product fulfillment, sales and marketing, accounting, HR, customer experience. All of these KPIs are built in these departments, but they all need to tie back to those intangible assets that are in your business. As a CEO, you need to pay your dues to each function of your organization until you're large enough to assign that responsibility to somebody competent. You need to pay the ignorance task because you have to build out certain systems and procedures that can at least get you off the ground, can at least get you to 50K a month. We only work with companies that are doing at least 50K a month, because before that, it's really just a revenue generating exercise of, all right, how are you getting your leads, right? But that's just the first step in running your business. So the order of replacing your role as the CEO or the founder as your business grows is like this. You need to replace your product management. So ironically, the CEOs and the founders are so obsessed with product management. We see it time and time again. The CEOs are on top of the R&D team. They're constantly aligned with, what do the customers want? How do they improve the product? And it's important. Don't get me wrong. It's really important. But you want to replace your product and fulfillment processes as fast as possible so that you can keep focusing on sales and managing the back end. Because the reality is, if you have a mediocre marketing strategy, but your product and fulfillment is good enough where there's a market need, you will bring sales in. That's not a question. But handling the marketing and sales yourself is the most important thing, because it's the lifeblood of your business. So once you have a good enough product, you can always make it better, of course. You got to replace it. You got to find somebody to manage that portion, because you cannot be running the fulfillment the entire time as a CEO. It's going to hinder your sales growth. It's going to hinder your operating growth. It's going to hinder your SOPs. The next thing you have to do is bring on the right CFO. And that's typically a professionally managed team that has a combination of CFOs and COOs who work together to bridge the gap between the operating and financial procedures of the company, because the way you operate your back end, your product and fulfillment, needs to be measured by the COO. Then your churn and your customer retention and your customer ascension is obviously at the end of this order of operations, but that still needs to be managed by the COO as well. Your COO is like your right-hand man, and your CFO works with the COO to make sure that what the COO is doing is actually producing positive shareholder value, right? After you get all of that sorted, after you can tie your KPIs that are associated with your product and fulfillment team, you can tie your marketing and sales efforts to how fast you're producing, how fast you're fulfilling, how fast you spend a dollar and get that dollar back, then you can replace your sales team. Because now you know the cost of your sales team and your customer payback period. The only way to actually do this is by having the numbers in front of you and set up in a way that's orchestrated between your CFO and COO. And that's why they're the next most important steps to scaling and getting you out of those day-to-day roles, right? So then you outsource your sales. You need to have HR and team management. Now, HR, I don't mean it in the sense of like a corporate monolith that has like a massive infrastructure and bureaucracy. We're not inviting bureaucracy. What we're simply looking for is someone that can do talent management, somebody that can make sure that you're bringing on 18 players in your business, because replacing your marketing and your R&D/customer ascension requires good talent. I think that you can have a business that's doing okay, but you're going to eventually need to bring in like A-level marketers to really scale your company and to also manage all the different channels. It's a massive operation and there's a lot of trust involved. And ironically, it's one of the last things you want to outsource, but having good HR and team management means that the core functions of your business, which is money coming in, money's being managed, products are being fulfilled, is sorted. So having that is like a massive check mark that we see with our portfolio companies and our client companies. Then we outsource marketing and R&D and customer ascension. Those are like the last steps. But the reality is those last steps, you're still going to be operating under. You're still going to be working on it. Founders will try too quickly to outsource the sales and marketing efforts of their business because they don't like it. It's the most ugly and painful part of running a company, but it's the most necessary. And the founder knows the company best. Making sales in terms of conversion rates is way more successful or profitable when you're a founder doing it than when you have somebody else doing it who doesn't really understand the business yet, or doesn't even understand the market need or what the whole market competitive landscape looks like the way the CEO knows. The CEO knows it the most, which is why we typically say CEO outsources the sales portion last. And your KPIs themselves are typically focused on the wrong goal. And as a founder, you really have one goal because you're trying to go from startup to business. So what does that mean? It's a speculative bet that you're making and you're trying to create an asset that produces cash flow. So until every part of your business is redundant, you just have a high paying job. You don't really have something that's producing cash flow that's an asset that you can look at it like, oh, my real estate property, I have renters in there and it's producing cash flow and I have a management company handling it and it's just an asset for me that I treat in my portfolio. You don't have that yet because you don't have redundancies in place in your business. But you need KPIs and the right CEO, CFO, and COO combination to actually make that work, because an asset still needs to be managed and needs to be maintained. So the issue really isn't your click-through rate or your R&D throughput time or your net promoter score. It's a lot deeper than that. Your KPIs aren't leading you anywhere because you don't know where you're going. People will make these arbitrary numbers and think, okay, this is leading me closer to my goal, but they don't even know what their goal is. And really, this is the question, right? Would you rather have a business that generates $50K a month where you personally only work 40 hours a week or even 20 hours a week, or a business that does $100,000 a month in revenue, but it costs you 80 hours? Can you tell what I'm alluding to? Pay attention, because this is the most important part. This is the most important KPI in your entire business, because this KPI represents your profit margin, right? because you're buying back your time every single time you make a hire, but it costs you money. Okay? Everybody is speculating on their time. The ultimate intangible KPI you need to be tracking is your time. That is the intangible that produces actual results, like I said earlier in this video. And that's why it's so important to learn the value of your time by delivering outcomes. You shouldn't value your time in a dollar sense. You should value it in a results sense. And that's what your business is. It's a results-based operation. And the whole point of technology in online business is to deliver outcomes that a human can produce in the shortest period of time. That's the entire edge. And that's why we focus on tech founders. That's why we focus on online businesses. Because for us, that is what edge we're looking for. As investors, as venture capitalists, we have a whole list of different types of factors that we can invest on. And for us, we're betting on the factor that reduces human time cost commitments and energy commitments. That's our investment thesis. If you go and you talk to another VC or another investor, they might have a different factor. But for us, we care about maximizing the intangibles in your business. So your business needs to address the bottlenecks first. You need to understand that by maximizing the efficiency in your company, by maximizing what's working, it's probably actually causing you to lose money. Because if your R&D team, right, completely maxes out on their development and they're just waiting, but your sales and marketing sucks, by keeping your R&D team on payroll because they're A-level players, but you don't have a good sales and marketing channel, you're losing money. They're great, they're very efficient, but you're still losing money, and you're losing money faster because they're so efficient. So sometimes slowing down the efficiencies of certain operations will help you save money. So what you need to do is you have to identify what's not working and use what is working to fix what isn't. And this is why founders who focus only on revenue never grow, because they don't see the core, they don't see the total effect of all these different functions in their business affecting the core thing. And the core thing is your time. It's the idea of turning this speculative bet into an asset. And this is where KPI waterfalls are so important. Because if I can segment every single portion of your business between product delivery, sales and marketing, any other functions in the company, and assign it to a margin delta, which is basically the change of a period month over month, year over year, I'll know what the dollar impacts are of each KPI. I will know what my future decision making looks like because I know what the probabilities of my KPIs are, and I know what the dollar costs are associated, or the profits associated by improving those KPIs. And what you get is this cascading waterfall where all of these functions play together to produce a net margin, right? Because it's your time. We're trying to improve your time as a business owner. And if we look at July and August, right, we have a 9% drop off between your product team. We have a small increase in delivery. We have a small drop off in your sales and marketing. These numbers are still positive. This is the only negative number. But because of this variance, right, because of this minus 6%, 3%, 3% gain, we still end up at a net negative 10% margin drop off month over month. And what you need to do, and I made this in another video, is set up a budget where it ties these KPI waterfalls to that budget so that you know how to decrease the variance in this. But you need to figure out what your core drivers are in your business so that you can understand what the costs and profits are associated with in making decisions, right? But you can't make decisions until you know what your probabilities are. And that's what KPIs are ultimately. They're just assigned probability values based on a certain number of repeatable events that have happened that you've studied. That's all it is. But we can see that those core drivers really impact your margins. And once we can go over like a 12-month period, we see that you actually had a 4% margin decline. And the bigger the numbers are, the more investor capital you take in, the more real those numbers are in affecting how people look at you. If you say you lost $400,000 versus 40 million, it's a really big deal. And I want you to know that everybody has access to the same KPIs. But I can show you 20 different ways to look at those KPIs depending on the goals your business needs to accomplish today. And that's why KPI management is one of the hardest things for a business owner who's transitioning from just focusing on revenue to now building a real company struggles with. So the goal is to identify the risk reward of your decision making before pulling the trigger. And it's not as simple as estimating the surface level costs. If you get rid of a COO, yeah, you save some surface level costs, but how does that affect your entire organization? How does that affect every single function in your group? Certain hires or fires are more than just surface level costs that have a price tag associated to it. And as a founder, your job is to figure out the KPI that will be affected by each decision you make and then assign a dollar profit or loss to that decision. And that's what we do as management consultants and as people who have our own portfolio companies. We come in and literally figure that out with our clients, right? I've used stats and quantitative modeling to manage literally billions of dollars in transaction volume. It's no different for your business. It's no different for the businesses that we've had that have had 8-figure exits. And I guarantee you, your business is no different. It's just lacking these things. So the key is to find the correlated actions, the correlated drivers that you're making in your operations, and then determine the profit and loss of your redundancies. Because it's important to have redundancies. It reduces key man risk. It makes you able to check out of the day-to-day operations and now work on your business where you're creating systems, and then eventually above it when you're treating it like a portfolio. And that's what we want to do. We want to get your business to a state where it's a real asset that can be treated on a portfolio level as something that you decide how to allocate, whether to do M&A, whether to raise capital. But all of these decisions come much later once you figured out the baseline stuff, which is your drivers, your KPIs. So important. So if you want to learn how we can help your tech business, your online business, go from a revenue generating operation where it's just, sales and marketing exercise into something that's a company, because we build companies, book a call today in the description below. We've been able to routinely identify and save millions of dollars for our clients, between 10 to 20% on average in the first 3 months. And we do it for our portfolio companies as well. It's a constant thing. Change is always happening. So if you're interested in learning how we can do this for your business, book a call in the description below.